GST Introduction. In this topic, we are going to first understand the concept of tax. That is, what are the various objectives for which the tax is levied on the people. We will understand what is the basic difference between direct tax and indirect tax. As every country which levies taxes are segregated into two categories, one is a direct tax and another is indirect tax. So we will study in detail what is the exact difference between direct taxes and indirect taxes. Then we'll study what are the basic features of indirect tax and what are the principal indirect taxes which are levied in India. Now, this existing tax mechanism of implementation of service tax, customs, excise, VAT, CST has been replaced with the new mechanism after introduction of GST. Now, only GST will be charged instead of different variety of taxes. Now, what is exactly concept of GST and why it is necessary in India, that we'll study in this topic. Now, for implementation of any act, we need to study what is the framework which has been implemented. So we'll study what is the framework of GST introduction in India. We'll also understand what are the various benefits which everyone is going to receive after implementation of GST. For bringing any act in a country, you need certain constitutional provisions and amendments. So we will study what are the constitutional provisions pertaining to charging various taxes in India and what were the requirements of constitutional amendments for starting GST. So let us understand all these points one by one in detail. When we talk about government charging taxes, the question comes in our mind is as to why the government levies taxes on the people. Now, the basic reason of charging any tax in any country is the government has to collect the revenue which has to be utilized for the purpose of public utilities. The prime responsibility of the government is to fulfill the increasing developmental requirements of the country. Now, facilities like roads, railways, bridge, metro, aeroplane facilities and all the other facilities are required to be given by the government to the general public. Now, these facilities can be made available to public at a cost, and this cost is required to be compensated by the revenue collections from the government. So what government does is the government collects revenue in the form of taxes and the same amount is utilized for fulfilling the obligations which are required for the developmental needs. Now, for any welfare state, the main objective is they have limited resources which has to be utilized optimally. Now, once you utilize the resources optimally, definitely the government can implement the developmental requirements in a much advanced and much better manner. Lastly, socio-economic objectives. The government wants to reach to the poor as well as to the common man who cannot afford to get the services at a very high price. And therefore, generally the government services like electricity and the other basic requirements are provided at a very lower cost. Now, this can be afforded by the government because the government has source of collection of revenue in the form of tax. Now, how the government is going to collect the tax and what are the different taxes that we have to study. Direct and indirect tax. As we have seen that every country which imposes tax can be segregated into broadly two categories. One is a direct tax and another is indirect tax. But what is the exact difference in both of them? Now, when we say direct taxes, it is a tax which is imposed on the person, that is directly the taxpayer. Now, here the person who is paying the taxes to the government will actually bear the burden of the tax liability. That means he cannot shift the burden of his taxes to someone else. For example, Mr. Ajit is generating income of 10 lakhs. Now, Ajit is required to pay income tax. Now, this income tax burden has to be borne by Ajit out of his income of 10 lakhs. So out of income, he will pay off the tax liability, and that tax liability cannot be shifted to someone else because this is a direct tax. Now, government introduced the concept of progressive taxation in direct taxes. So here, generally, the higher rate of tax is imposed for the people who are having the higher ability to pay. In short, the people having higher income or the people belonging to higher categories of income will be paying taxes at a higher rate. On the other hand, people having lower income will be paying taxes at the lower rates. Now, broadly speaking, in India, income tax and wealth tax were one of the major direct taxes collected, out of which wealth tax is no longer applicable in India. But the income tax, which is one of the main source of revenue collection for the government, is using the concept of progressive taxation. That means people up to 2.5 lakhs are not paying taxes, but the people above 10 lakh are paying taxes at the rate of 30%. So this is known as progressive taxation. Indirect taxes. Now, after learning the concept of direct tax, let us understand what is indirect tax. Now, indirect taxes are levied on consumption, expenditure, privilege, or right, but it is not charged on income or property. Now, here the person who is a taxpayer is considered as an intermediate person, or you can say a medium or channel, which at every stage of tax incidence he collects the taxes and deposits with the government. That means ultimately the responsibility of bearing tax is lying with the customer. Here, the taxpayer can easily shift the burden to someone else because he is a medium who is collecting taxes and depositing with the government. A number of indirect taxes which were levied in India were excise duty, customs, service tax, central sales tax, value added tax, entry tax, purchase tax, entertainment tax, lottery, gambling, betting, luxury tax, taxes on advertisement, and so on. Now, in all these indirect taxes, what used to happen is the person who is a businessman used to charge the customer, or you can say the client, the indirect tax, and he used to collect and deposit with the government. For example, service tax. In service tax, the service provider used to charge the amount of service taxes on the invoice. Let us say Mr. A is a professional chartered accountant and he is rendering services to ABC Limited. Now, when he is going to raise an invoice of 1 lakh, in that he used to add service tax, let us say 15%. So he used to charge service tax of rupees 15,000. So the total bill amount would have been 1,15,000. So he will collect 15,000 from his client and then deposit with the government. Now here, chartered accountant was the person who is considered to be a taxpayer, but he will not bear the burden. That burden will be shifted to the client. Now this is how the concept of indirect tax works. Now, because of lots of complication, the government of India has decided to change the existing tax structure and introduced new act which is known as GST. With effect from 1st July 2017, large number of central and state indirect taxes were merged into single tax which is known as a goods and service tax or GST. Let us understand what are the various features of indirect taxes. First is main source of revenue. For Government of India, indirect tax is considered to be one of the major source of revenue which which kept on increasing from year to year, and therefore government felt the importance of levying indirect taxes. Next is shifting of burden of tax payment. As we have seen that in indirect tax, the burden of the tax payment is not on the taxpayer, but the taxpayer is shifting the burden to their clients, and ultimately the burden of indirect taxes is borne by the ultimate customer. Next is it is levied on goods and services. As we have seen that in case of earlier tax mechanism, when the person used to sell the goods in local area, he used to charge VAT. But when he used to sell the goods outside the state, he used to charge CST. As far as services are concerned, the person used to charge service tax at the time of providing the service. So basically, this tax is levied on goods as well as services. No direct impact felt by the customer. Now, as far as any indirect tax is concerned, the taxes are usually included in the final price. So, what customer pays is the final price, or which is a price known as MRP. That is the maximum retail price which the customer pays, and therefore, usually the customers are not aware exactly how much taxes are being borne by them. Next is wide base of tax. Now, since the customer is bearing the taxes and it is levied on the goods and services, majority of these taxes are collected by the government, and the base of this tax liability is very wide. That means the taxes are imposed on majority of the products and services, because of which it happens that the taxes are collected from the wide base. Next is it leads to inflation. Naturally, when the product is consisting of the tax liability, definitely it will lead to the inflation. That means overall prices of the products will keep on increasing because of the indirect taxes levied. So definitely it leads to inflation. Nextly, promoting social welfare. These taxes are collected in order to provide the services or facilities or public utilities, and therefore for promoting social welfare the indirect taxes are collected. Lastly, same rate for poor and rich person. Now it does not make any difference whether the person is having income of 2 lakhs or whether the person is having income of 2 crores. The amount of indirect tax borne by the person is same, because there is no concept of progressive taxation in case of indirect taxes. Let us understand what is the genesis of GST in India. That means how the GST was introduced in legal terminologies. The concept of GST was strongly recommended by the Kelkar Task Force, and they introduced that the GST should be implemented on a national level, which should be considered as tax which will replace majority of the existing taxes. Subsequently, the Union Finance Minister Shri P. Chidambaram, while presenting the central budget for 2007-8, announced that GST would be introduced in India with effect from 1st April 2010. But unfortunately, considering the litigacies and considering the problems involved in implementation of GST, the GST implementation was not possible in 2010. But later on, government kept on trying to implement GST as soon as possible. Fortunately, there was a speedy update between 2014 to 2016. Government tabled the Constitution Bill 2014 on GST in the Parliament on 19th December 2014. The Lok Sabha passed the bill on 6th May 2015 and Rajya Sabha on 3rd August 2016. And finally, after approval of President in September 2016, it became Constitutional Act 2016. Basics of GST. Now we'll understand globally as to how GST was introduced and how various countries adopted the concept of GST. France was the first country to implement GST in the year 1954, and within a period of 62 years of the introduction, about 160 countries across the world have adopted the GST. Now this is mainly because the GST has the capacity to raise revenue in the most transparent and neutral manner. GST is globally considered to be a value-added tax which is imposed on manufacture, sell, and consumption of goods and services. And therefore, GST is considered as the tax which is levied on the value addition, and therefore it is considered to be one of the comprehensive taxes which will eradicate the requirement of different variety of taxes. Next is GST offers comprehensive and continuous chain of tax credit from the producer's point of view till the retailer's level or consumer's level. The same happens in case of services from the service provider up to the service recipient, that is the ultimate customer. Now here the person at every level of value addition will end up paying taxes only on value addition made by him, and because of which there is no cascading effect. That means there is no question of double taxation and there is no question of paying extra taxes on the earlier tax payment. Limitations of the existing value-added taxation system. Now, why any tax is required to be replaced is mainly because of the lacunas or limitations of the existing system. Now, in existing VAT mechanism, the manufacturer of excisable goods used to charge excise duty and value-added tax on the intra-state sale of goods. But unfortunately, the credit for value-added tax, that is VAT, and excise duty were not available against each other. And for the manufacturer who is selling goods in the same state is required to pay two different taxes. One is a excise duty and another is VAT. Next is various indirect taxes being levied were not necessarily mutually exclusive. Now, as we have seen the example, now here the person who is manufacturer is paying excise duty and same person is paying VAT. So there is not clear-cut segregation that who will pay which kind of tax liability. So even though definition-wise it is a segregation, but practically one person end up paying more than one tax liability. Limitations for SENVAT credit. Now there were several limitations of utilizing SENVAT credit. That means credit of excise duty against service tax or vice versa was available. But credit of CST against VAT or credit of VAT against service tax or VAT against excise duty was not possible. And this lead to limited SENVAT credit utilization and people used to end up paying more taxes. Now there were several taxes like luxury tax, entertainment tax, for which there is no credit available. Because of all these lacunas, the GST was implemented in India. Now, introduction of GST to overcome various problems of the existing tax system. A comprehensive tax structure covering both goods and services was required, and considering this requirement, the GST was introduced. Now, simultaneous introduction of GST at both central and state levels has integrated taxes on goods and services for the purpose of set-off relief and ensures that both the cascading effects of same VAT will not be made applicable, which were because of simultaneous introduction of GST at both central and state levels. The majority of the taxes on goods and services are integrated, and because of which set-off and relief procedure has been easily possible, and it is ensuring that whether it is a set-off and whether it is a relief, both are avoiding the cascading effect because of same VAT. In GST regime, the major indirect taxes have been subsumed in the ambit of GST. There are a variety of indirect taxes which have been merged in GST. Now, earlier tax mechanism used to charge excise duty, service tax, VAT, CST. All these taxes have been merged and only one GST is made applicable. Framework of GST as introduced in India. In India, there is a concept of dual GST. That means the government of India has segregated the GST in two categories. One is GST for interstate transaction and GST for intrastate transaction. Now, when a person is selling the product locally, that is within the same state, or when the person is providing the services in the same state, then CGST or SGST is made applicable. For union territories, the UTGST is applicable. But when a person is selling the product outside the state, that is, for example, Mr. X is selling product from Mumbai to Gujarat, then IGST is made applicable. Same rule applies for the services rendered from one state to another state. Now, this segregation is required for clearly segregating the transactions which have been concluded within the same state and the transactions which have been taken place in two different states. Next is legislative framework. For introducing any act in India, there has to be a legal background created. and therefore the government of India has taken step-by-step procedure for implementation of GST. And finally, the GST Act has been introduced in India and which is made applicable from 1st July 2017. Classification of goods and services. Now, the similar mechanism was applicable in case of excise earlier, and the same has been continued in GST, wherein HSN coding has been made applicable. In subsequent chapters, we'll discuss about how HSN coding is done and how the numbering for the product or services has been decided. Next is registration. Now, Government of India has put up certain requirement for registration under the GST, like for all the people or all the businessmen who are existing assessees under excise, VAT, CST or service tax will automatically get converted in GST. That means they are required to mandatorily get themselves converted into GST mechanism. And as far as newly started business or as far as new entrants are concerned, there is a limit of 20 lakh which has been put down. So if your business turnover crosses 20 lakh, then you are required to get registration in under GST. Now for certain northeastern states, the limit has been put down to rupees 10 lakhs, and for other states the limit is 20 lakhs. But if a person wish to voluntarily get registered in the GST mechanism, then he can voluntarily get registered also. Next is a composition scheme. Now under composition scheme, the person is getting benefit not to get taxed at a higher rate but to get taxed at a particular fixed rate without getting benefit of input credit. Now how composition scheme is made applicable in India, that we're going to see in subsequent chapters in detail. Exemption. For certain goods and services, the Government of India has decided for non-application of GST. That means for certain goods and for certain services, GST will not be made applicable. So those goods and services will come under exemption list. The government has clearly identified how the input tax credit will be utilized. That is, manner of utilization of ITC has been clearly defined as to how input tax credit will be utilized. In subsequent points, we will see those parts, that is as to how the credit for input tax is availed. Seamless flow of credit. Now, earlier taxes, there was certain restriction for application of input tax credit. Like input tax credit for service tax was not made applicable against VAT liability. But here there is no problem whether you are providing goods or whether you are rendering services. The credit for both goods and services and manufacture can be taken. So that means the scope of input tax credit has been widened considerably. Next is GST as a common portal. Now, instead of registering under excise, customs, VAT, CST, service tax, they have made it very smooth process wherein a person is not required to get registered under excise, service tax, VAT or CST, but only one GST common portal is available wherein the person can go and register online and do the tax compliances, subsuming the tax liability. Now, because of the introduction of GST, various taxes were subsumed under the GST mechanism. These taxes include various taxes like excise, VAT, service tax, CST, and various other taxes which are levied by the state government. So, after introduction of GST, all these taxes will get subsumed and merged under one tax net, that is known as GST. So this is a framework for introduction of GST in India. Now we'll see how the GST will be charged and how the input tax credit will be taken. Now let us understand how GST is charged for a local sales. Illustration on intra-state supply. Let us take one example that when a person deals with another person in the same state, then how GST is charged. Mr. Viren from Gujarat is selling product to Mr. Hiren in Gujarat worth rupees 2 lakh, and Hiren is subsequently making the value addition of 25% and selling the product to Mr. Mihir in Gujarat. Compute GST payable by Viren and Hiren. Now here Viren is the initial person who is going to manufacture and sell the product worth rupees 2 lakh within the same state. So Viren, while charging the GST to Mr. Hiren, he will consider CGST and SGST at the rate of 9%. Now, when he is charging the taxes, we have to consider that 2 lakh is the price of the goods, 18% is the tax rate, half is CGST that is 9% and half is SGST that is 9%. So on value charged by him worth rupees 2 lakh of goods, you will charge 9% of CGST that is 2 lakh into 9% which is 18,000 and SGST at the same rate that is 2 lakh into 9% that is 18,000. If we take the total bill amount will be 2 lakh 36,000. Now this is the price which will be charged by Viren to Mr. Hiren. Now this happens because Mr. Viren and Hiren both are doing the business in the same state that is Gujarat. Now for the subsequent sale by Mr. Hiren to Mr. Mihir, the sale is also within the same state. Therefore again CGST and SGST is made applicable. Now let us understand how these taxes will be charged and collected. Now when Hiren is going to sell the product to Mr. Mihir, he is going to add 25% of the value addition. So 2 lakh multiplied by 25%, so his selling price will be 2 lakh 50,000. So value charged for supply of goods and services by Mr. Hiren to Mr. Mihir will be 2 lakh 50,000. On 2 lakh 50,000 again he will charge CGST at the rate of 9% and SGST at the rate of 9%. So 2 lakh 50,000 into 9% comes to 22,500. It means when Hiren is selling product to Mr. Mihir, he will charge 22,500 as CGST and 22,500 as SGST. So the total price charged by A to B will be 2,95,000. Now here Mr. Hiren being the intermediate person, he is eligible for taking the input tax credit, which is the best mechanism introduced in GST, wherein the person who is an intermediate person can take the credit for the input taxes paid. Now let us understand how the net CGST and SGST payable will be computed. Now for first dealer, that is Mr. Viren, there was no credit available because he was the initial dealer. But Mr. Hiren, who is an intermediate dealer, for him the CGST and SGST payable will be as under. CGST payable will be rupees 22,500, that is the taxes charged by Hiren to Mr. Mihir, that is taxes on the goods sold. But at the same time he has already paid taxes worth rupees 18,000 to Mr. Viren. So he can take the credit of 18,000 against this liability. So again CGST of 22,500, he can take the credit of 18,000. So net CGST payable will be rupees 4,500. So against 22,500, 18,000 credit. So net 4,500 would be the amount of CGST payable to the central government. So this amount will be paid by Mr. Hiren to central government. And secondly, SGST. As far as SGST is concerned, again the same technique is available or same method is available. The output SGST, that is SGST charged by Hiren to Mihir, is 22,500 and already he has paid SGST of 18,000 to Mr. Viren at the time of purchasing the goods. So the net payable will be 22,500 minus 18,000. So net SGST payable will be rupees 4,500. Now this is the tax, that is SGST, will be paid by Mr. Hiren to the government. Now this is the mechanism in which the GST is charged in case of intra-state transaction. But let us say in the same case, if Mr. Hiren is not selling the product to a person in the same state, but he is selling the product to someone else who is staying in another state, then let us take an example that if Mr. Hiren has sold this product to Mr. Mihir in Maharashtra, then what will happen? Now in such case, the calculation for Viren to Hiren will remain as is because both Viren and Hiren are staying in the same state. But when Hiren is selling the product to Mr. Mihir in Maharashtra, then both of them are staying in two different states and therefore IGST will come into picture. Now when Mr. Hiren is selling the product to Mr. Mihir in Maharashtra, he will be required to charge IGST. As we have seen that the selling price for Mr. Hiren was rupees 2,50,000. So on 2,50,000 he will directly calculate 18%, that is 2,50,000 into 18% will be rupees 45,000. So this 45,000 would be the amount of IGST. Now the total price which will be charged by Mr. Hiren to Mr. Mihir will be rupees 2,95,000. But now the question arises how he can take the credit. Now as far as rules are concerned, the input tax credit, there is a more liberty for taking the input tax credit, and therefore as we can see here, for Mr. Hiren the input tax credit for both CGST and SGST is made applicable. That means Mr. Mihir can first take the credit of CGST against IGST, and if some balance amount is still available, then against SGST the credit can be made available. So the net amount of taxes which will be paid by Mr. Hiren to government will be total IGST is 45,000, out of which CGST credit is 18,000, which he has already paid to Mr. Viren, and also he has paid SGST of 18,000 to Viren because this transaction was within the state. Now against 45,000, this credit of 18,000 plus 18,000, that is 36,000, will be taken into consideration. So the net 9,000 will be considered as net IGST payable by Mr. Hiren. Now this is how the input tax credit can be considered in case of interstate transaction, and this is how the input tax credit can be utilized.